Problem 17.8. Brooks Corp is a medium-sized corporation specializing in quarry stone for building construction. The company has long dominated the market, at one time achieving 70% market penetration. During prosperous years, the company's profits, coupled with a conservative dividend policy, resulted in funds available for outside investment. Over the years, Brooks has had a policy of investing idle cash in equity securities. In particular, Brooks has made periodic investments in the company's principal vendor of mining equipment, Norton Industries. Although the firm currently owns 12% of the outstanding common stock of Norton Industries, Brooks does not have significant influence over the operations of Norton Industries. Cheryl Thomas has recently joined Brooks as assistant controller, and her first assignment is to prepare the 2020 year-end adjusting entries for the accounts that are valued by the fair value rule for financial reporting purposes. Thomas has gathered the following information about Brooks' pertinent accounts. 1. Brooks has equity securities related to Delaney Motors and Patrick Electric. During 2020, Brooks purchased 100,000 shares of Delaney Motors for $1,400,000. These shares currently have a fair value of $1,600,000. Brooks' investment in Patrick Electric has not been profitable. The company acquired 50 million shares. I'm sorry. Brooks' investment in Patrick Electric has not been profitable. The company acquired 50,000 shares of Patrick in April 2020 at $20 per share, a purchase that has a current value of $720,000. 2. Prior to 2020, Brooks invested $22,500,000 in Norton Industries and has not changed its holding this year. This investment in Norton Industries was valued at $21,500,000 on December 31st, 2019. Brooks' 12% ownership of Norton Industries has a current fair value of $22,225,000 on December 2020. Prepare the appropriate adjusting entries for Brooks as of December 31st, 2020 to reflect the application of the fair value rule for securities described above. In order to calculate the fair value adjustment, we need to figure out the unrealized holding gain or loss. So within this table, we've categorized different details of the security, including um, pertinent information. So we have the name of the security, number of shares, and the purchase cost. So during 2020, we purchased Delaney Motors for $1,400,000, and the fair value at the end of the year was $1,600,000, resulting in an unrealized holding gain of $200,000. Patrick Electric was also in one. We purchased 50,000 shares for $20 per share in 2020, and that equates to 1 million. The fair value at the end of 2020 was 720,000. The difference between the purchase cost and the fair value at the end of 2020 was a unrealized holding loss of 280,000. Also in 2020, in 2019 we had initially purchased Norton Industries for 22,500,000, and the fair value at the end of 2020 was determined to be 22,225,000. So the difference between the purchase cost and the fair value at the end of the year was an unrealized holding loss of 275,000. The net of these gains and losses on these equity securities is a net loss of 355,000. prior to 2020, we had ownership in Norton Industries. Remember that we purchased in prior to 2020, we purchased 22,500,000 worth of Norton Industries. And at the end of 2019, the investment in Norton Industries was valued at 21,500,000. The difference between the purchase cost and the fair value is the unrealized holding gain or loss, this being a loss of 1 million. Therefore, at the end of 2019, we would have made a journal entry with a debit to fair value, with a debit to unrealized holding gain or loss income of 1 million and a credit to the fair value adjustment account for 1 million. So now at the end of 2020, the balance that we need in the unrealized holding gain or loss account needs to be a credit of 355,000 in order to go from a credit balance of 1 million to a debit balance to a credit balance of 355,000. We need a debit to the fair value adjustment account for 645,000, which is the journal entry at the year end of 2020 that we need to make for part A. Part B, it asks us how the securities to describe the results of the valuation adjustments made in part A, how they would be reflected in the body of Brooks' 2020 financial statements. And the unrealized holding gain or loss would be reported in income because we are assuming that these are available for sale securities, and we measure these at fair value. And so these would be reported on the unrealized holding gain or loss would be reported on the income statement in the other revenues and gains section. Part C, prepare the journal, the entries for Norton investment, assuming Brooks owns 25% of Norton's shares. Norton reported income of 500,000 in 2020 and paid cash dividends of 100,000. So if we own 25% of Norton Industries, we use the equity method. So 25% of Norton Industries net income would be would increase our investment in Norton Industries. So we would at the end of the year of 2020, we would make a debit to equity investments for 125,000, and we would credit investment income for 125,000. And then we would also get 25% of the dividend that Norton Industries paid out. 25% of 100,000 is 25,000. So we received cash. We're going to increase cash, debit cash for 25,000, and credit equity investments for 25,000. This journal entry can be thought of as a return of capital, where our company that we're using the equity method to report income is giving us back our investment. They're giving us cash back. So that could be the reasoning behind this journal entry. And that is all for this question. I want to thank you for taking the time to watch it, and I hope this helps you with understanding the fair value measurement and um, timing and reporting of the fair value rule for financial reporting purposes. Thank you.